Welcome back, everybody. Earnings season continues on, and we have three updates to talk about today: American Express, MSCI, and Meta. And believe it or not, I actually sold one of these companies completely out of my portfolio, but you're going to have to keep watching to find out which one. So let's go ahead and get started with American Express. Now, you guys know I like to go back to their previous quarter's guidance to see what they actually told us they would do. Now, in Amex's case, it's not really quarter-to-quarter guidance. It was their 2024 guidance that they had updated, and they basically guided for revenue growth for the year of 9% and earnings per share growth between 23 and 25%. So let's take a look at what they announced for Q4 and for the full year. So for the full year, as we can see, revenue was up 9% and earnings per share was up 25%. So just right off the bat, we can see that Amex actually hit their full year guidance for 2024. Plus, as they already announced, they're increasing their quarterly dividend by 17% to 82 cents per share, which is a really nice raise. And if we go through the details, we can see that on a quarterly basis in Q4, revenues were also up about 9% and earnings per share was up 16% from the previous year. And if we take a look at their earnings call presentation, we can see the same story here with a little bit more detail. So total revenues up 9%, obviously net income up 21%, and then diluted earnings per share up 25%. And if we look at the individual slides, what you're going to see is a common theme. Now, this is total billed business, but you can see that the percent increase from the previous year was 8%, and that's higher than it's been from the previous 4 quarters. Then if we come down to U.S. consumer services, we see that it was 9%, again, higher than the previous 4 quarters. Even commercial services at 4%, still higher than the previous 4 quarters. Then international card services, again, 15%, which is higher than the previous 4 quarters. So just on the surface, right, what you're seeing with Amex is a company that across all of their business lines is basically growing at a rate that's accelerating from what it's been over the past year or so. So to me, that is nothing but positive news. And if we come down to revenue performance, we can see the breakdown of how their revenue is growing. And let's look at just Q4 for right now. You have discount revenue up 7%, net card fees up 18%, and then net interest income up 12%. And if you guys remember, we actually talked about this last quarter as it relates to Amex. The reason why this is important is that net card fees and net interest income are two revenue sources that aren't related to card member spend, because card fees are actually the annual fees and things that card members are paying, and net interest income is actually the difference between the interest they earn for people that have revolving accounts compared to the interest they have to pay for anybody that has deposit accounts at their bank. So what's nice about that for American Express is your two highest growth areas in terms of revenue are not actually tied to card member spend. And the reason why I think that's good is because if we do have kind of a recession or the economy goes the other way, then it's not going to be as impactful to Amex's overall revenue. And if we look at year-over-year growth, we see the similar trend. Net card fees is 16% and net interest income is 18%. So this is a trend that's continued basically throughout the whole year. But the other part of this that we talked about last quarter is that if you have a high percentage of your revenue coming from card fees, then the question is always, well, at what point do your card members just not want to pay fees anymore? And so one of the things that I like to look at is the actual health of the credit portfolio. So if we look at credit metrics, we can see that the percentage of card member loans and receivables that are 30 plus days past due is holding steady at 1.3%, which is still less than the pre-pandemic number of 1.5%. And then if we look at their net write-off rates, it's again holding steady at 1.9%, which is still under their pre-pandemic level. And then now their total provision for credit losses is coming down a little bit, which I take as a very small signal that they don't think there's more trouble on the horizon of people being more delinquent or having to write off accounts. So what you have is a company that seems to be growing in all parts of their business, getting good revenue growth in key areas, and having a credit portfolio that seems to be pretty healthy. But that doesn't mean that everything about this quarterly report was perfect, because there is something that's a little bit concerning that we're going to dig into right now. And that's Amex's rising expense growth. And we talked about this last quarter as well, but this is a trend that seems to be continuing. Now, you have card member rewards up 15% year over year for the quarter, business development up 10%, card member services 20%, marketing 31%, and then operating expenses actually down 1%. But overall, you have double-digit expense growth for the quarter. And if we take a look for the full year, we see that card member services is at about 21%, so that's holding steady. But for all the other ones, it looks like it was accelerating in Q4. So the question there obviously is that a trend that's going to continue, or was it more of a one-time thing? And the main thing for me is that expense growth for the year was only 6%, but in Q4 it was 11%. And remember, revenues are only growing at 9%. So if expense growth starts to outpace revenue growth on a consistent basis, then to me, that'll be a little bit of a concern. But then lastly, let's take a look at what their guidance was for 2025. So their long-term aspirational goal is to have revenue growth at 10% plus and earnings per share growth at mid-teens. And right now, what they're guiding for 2025 is revenue growth at 8 to 10% and then earnings per share at about $15, which would be about 12 to 16% earnings per share growth. And in terms of the market reaction, Amex fell about 1.5% the day after earnings, and it's kind of stayed flat for the rest of the week. So in general, my thoughts on American Express was that it was a really good quarter. They're actually accelerating growth pretty much on all lines of their business. Their credit portfolio looks really strong. And at the end of the day, yes, expenses are going up, but I look at it as just something to watch, and we'll just see kind of what happens. But the one thing that I will say has been a little bit concerning is that revenue growth has been decelerating. Like it was about 10% maybe like a year ago, and then it's down to 9%. Now they're guiding for 8%. And so I think that's something to kind of watch out for, to say, okay, they're still in that range of, mid-teens earnings per share, but it just seems to be decelerating right now. And when you have a stock like Amex that's been on an amazing run, that's something that's just a little bit of a concern. Because if we just take a look at this stock over the past year, it's up over 56% over the past 12 months. And if we just look at my portfolio real quick, we can see that Amex is my top performer at over 107%. And that's about the 2 years or less than 2 years that I've held it, right? So for a relatively mature financial services company, that's amazing performance. And so part of what I think about when I look at it now is, okay, we have a little bit of decelerating growth as it relates to revenue and even earnings per share. But in general, the business is strong. I love the brand and all those things. But my question is, okay, at what point do I need to consider Amex as potentially a place to trim a little bit, right? Now, I'm a little hesitant to do that because the last time that I trimmed it, probably a year ago or maybe a little over a year ago, was one of the worst decisions that I made from a performance standpoint because the stock just kept going up. But it is one of those things where if I see a better opportunity out there or something that I just don't want to miss or I want to go heavier on, then this may be an area where I start to trim a little bit. At the end of the day, I do still want to hold this company, so I'm not going to get out of it completely. It's just something I'm thinking about. All right, next up, let's talk about MSCI. Now, MSCI reported their earnings for Q4 and full year 2024, and here's what they reported. Operating revenues were up 7.7%, organic up 7.4%, which excludes acquisitions basically. Recurring subscription revenues were up 7.5%, asset-based fees up 20%, operating margin at 54.5%, and diluted earnings per share was down 23.1%, which is just a ridiculous number, but it's because of the acquisition. So if you go to the adjusted number, it was actually up 13.6%, which is just a huge swing. Now, one thing that I thought was interesting that we're going to talk about here in a minute is new recurring subscription sales were actually down by close to 1%. Now, one thing that MSCI did pretty well, I think, in 2024 was doing a bunch of repurchases at decent prices, down to $541.20 in terms of average repurchase price. And then they also announced a dividend increase of 12.5%. And in terms of what the market thought about MSCI's report, it was down over 5%. So the first thing that stood out to me in this report is that revenue growth is now in the single digits. And to me, it's a little bit of a concern for a company like MSCI just because of the valuation that they trade at. Because right now they're trading at a price to earnings of 41, a projected price to earnings of 45, as well as a price to cash flow of 33 and projected price to cash flow of 35. So what that means is that you're paying a premium valuation for a company that right now, at least, or this previous quarter, is growing at single digits. And just to compare, let's take a look at what it was in the third quarter. You had operating revenues up 15%, or actually organic was up 11%, and then recurring subscription revenues were up 15%. So it caught my eye because obviously revenue growth is important, but for MSCI specifically, recurring revenues are such a big part of their value proposition, or at least one of the reasons why I was personally interested in them. So that was something that I really wanted to look into more. So if we scroll down to their breakdown, let's see where they put it here. So if we look at the breakdown, what we see is that index was up 8.4%, analytics up 4.9% in terms of recurring subscriptions, ESG and climate up 10.8%, and then private assets was up 7.4%, which then from a consolidated basis equaled 7.5%. But one thing that stuck out to me is that if you look at the full year number, basically other than index, which is about the same at 8.3 and 8.4, all of the others are significantly lower than their full year number. So to me, what that says is you have decelerating recurring subscription growth, which one is very hard to say, but two is a little bit concerning. And the reason why I think this is important is that ever since that I added MSCI to my portfolio, I've talked about how them being the ESG data leader was kind of like a double-sided coin, where it can be a positive in some aspects, but it can also be a negative depending on what the sentiment is. So to me, I just viewed it as an overall risk. So spoiler alert, MSCI is a stock that I sold, and I sold completely out of it, and I actually did it before earnings. I did it on Monday, and I'll talk about why here in a minute. Now, there were three main reasons why I sold. Number one, I talked about potentially consolidating these smaller holdings that I had, and MSCI was like a little over 3%, and I kind of questioned, do I really need that? Maybe I can have less holdings, and this seemed like an obvious area to look to cut. But then two, I was skeptical that being the ESG data leader was a market-beating advantage going forward, just because you know how sentiment changes, and in this case, BlackRock is a huge user of that data, so if they change their mind one day, then that's going to be a huge impact to MSCI. So it was one of those things where I just didn't feel that strongly that was really the secular trend that I wanted to attach myself to. But then lastly, the reason why I did it on Monday instead of waiting for earnings was because the DeepSeek stuff that crashed NVIDIA and Taiwan Semi just was too much of a good opportunity that I didn't want to pass up. I wanted to go heavier on those two stocks after they dropped a bunch, like over 15% in a day. And so I said, you know what? Now's the time to get rid of MSCI. I was already thinking about it anyway, and there's some really good opportunities out there to pick up more of two companies that I feel really strongly about in a secular trend that I feel even stronger about than the ESG data secular trend. So that's what I did. So I sold MSCI around $616 on Monday, and I added those funds into NVIDIA and Taiwan Semi. So obviously in hindsight, looking at what the market did to MSCI after earnings, it was good timing for me to sell on Monday. But it was just a combination of all those factors. And it's one of those things where I think MSCI is a really good business, right? But when you look at the valuation that they're trading at right now, it's a little bit tough to justify single-digit growth when you're trading at, 40 PE or 35 price to cash flow. So it's one of those things where I feel like there's better opportunities out there. Even though it's a solid business, there was just a combination of factors to where I wanted to allocate my funds to different things, and this was an obvious place to cut. All right, last but not least, let's talk about Meta real quick. Now, let's go back to the third quarter where they provided guidance for Q4. They said we expect fourth quarter total revenue to be in the range of 45 to 48 billion, and we expect full year 2024 total expenses to be in the range of 96 to 98, and we expect full year 2024 capex to be in the range of 38 to 40. And so if we take a look at what they actually reported, they had revenue of just over 48 billion, so they beat on that. Costs and expenses for the full year were actually 95 billion, so they were slightly under their original guidance. And if we just look at capex real quick and we'll go back up, it was for the year a little over 39 billion, so it was right there within that range. But if we just go back, revenue growth was 21% year over year in Q4, which is just amazing growth for a company of this size. I mean, Meta has just been crushing it. And if we look at their full year growth, it was also 22%, so kind of in the same ballpark. And if we look at their earnings per share growth, it was 50% for the quarter and 60% for the year. Like, I don't think we realize how amazing these numbers are, right? Like, how many companies are doing this right now, especially at this size and at this profitability. So, we've talked about it many times in the videos, and sometimes I'll get these comments that are kind of critical of, oh, you just keep buying big tech and you're buying all these expensive companies. But the reason why is right here. I mean, what kind of companies are growing 20% revenue and 50% earnings per share? Like, is it really that expensive at that point? Like, I think that's the question we need to be asking ourselves, because if we just look at Meta here and we look at their valuation, you have a company from a PE perspective is trading at 31, projected PE at 29, but then their earnings per share is growing at 50 to 60%. Or like if we go to cash flow, their price to cash flow is 20, but yet their cash flow is growing by like 28 to 40%, depending on if you're looking at the quarter or for the full year. So again, it may be expensive if you're just looking at PE or price to cash flow, but it's really not if you factor in their growth. And if we take a look at what they guided for next quarter, you can see that they expect first quarter 2025 total revenue to be in the range of $39.5 to $41.8 billion. This reflects an 8 to 15% year-over-year growth, or 11 to 18% growth on a constant currency basis. And they said at this point, they're not providing a full year 2025 revenue outlook. We expect the investments we're making in our core business this year to give us opportunity to continue delivering strong revenue growth throughout 2025. And they said they expect full year 2025 total expenses to be in the range of 114 to 119 billion. And in terms of CapEx, they expect it to be in the range of 60 to 65 billion, which if you've been following the news, Zuckerberg recently said that like a week ago or a few days ago that was going to be the number. Now, in terms of the market's reaction so far, now it's just after market since it happened after the bell today, but it's up about 2.29% in the post market. It was up at one point, I think, over 5%, and it's come down a bit. So we'll see what happens tomorrow when the actual market opens and people start trading. But as of right now, it's up a couple percentage points. But let's take a look at their presentation to see a little bit more about what's going on in their business. Now, when I see these meta charts, I'm always just like, man, this is just insane. Like, look at the scale of what we're talking about here and all the different geographies and just how much they do all across the world. It's just really unbelievable. But okay, that's probably not interesting to you guys, but it is interesting to me. And if we go to this expenses as a percentage of revenue chart, it's pretty consistently trending down. Now, it's not just that they're cutting costs, right? That's definitely part of it. They're a lot leaner now than they were like 2 years ago in 2022. But it's also that the revenue is growing so much that expenses as a percent of revenue is getting smaller, if that makes sense. Now, again, if we look at net income, it's just one of those charts that's just a beautiful chart. If you're an investor, you're like, wow, this is exactly what I want to see. Just a nice growth trend up and to the right. Earnings per share, same trend. And then CapEx, unfortunately for some, is the same trend. Now, one of the reasons why I don't use free cash flow as much in my calculations when I do valuation and all that is because I feel like free cash flow can mean different things for different companies. And the example I'll give here is that when you have a company like Meta, they're spending a lot of money in CapEx, right? They're just pumping money into it, but it's all to aggressively invest for the future, right? Where you can have another business that's maybe more capital intensive, where it's a lot of CapEx being spent just to maintain their current business over time. To me, those are two very different reasons to look at CapEx. Because in Meta's case, look, all the money that they're spending, we may not get an ROI on it, or we might, right? But they're still investing for the future. So my view on it is, one, they could technically stop if they wanted to, and then all of a sudden their free cash flow goes magically up. Or two, they're actually going to see those benefits down the line because they're not standing still, right? Whereas if you have a company that is spending a lot of CapEx just to maintain their current business operations, then to me, that's a more valid reason to say, hey, look, their free cash flow is low, and maybe that's a concern. So I know not everyone's going to agree with that, but that's kind of how I look at it and why I don't worry about, oh, well, Meta's free cash flow yield isn't good. Well, I don't really care because they're investing that money into the future, and I'm trusting the fact that that's going to bear fruit down the line. And then if we go down, we see family daily active people. And I just like looking at this chart every quarter because now it's 3.35 billion people that are active daily on a Meta platform across the whole world. That is just an insane number. And it gets bigger every time. Obviously, average revenue per person is going up. And now here, let's get to some interesting stuff about ad impressions. Now, ad impressions are actually going down, right? Now, is that a good thing? Is that a bad thing? I don't really know because I don't know the context of why they're going down, but this next chart helps. But yet the average price per ad year over year is consistently going up, right? And I saw somebody talk about this. They're like, oh, this is a bad business model because ad impressions are going down, but price per ad is going up. To me, I feel the exact opposite. This is a good business model, assuming that the ROI for the advertisers is still worth it, right? Because at the end of the day, if you're showing less ads, that means it's probably a slightly better user experience. But if the advertisers have to pay more for each ad, then what you're getting is more money, even though you're showing less ads. And as long as the advertisers are happy because the actual return they're getting on that spend is still good, then it's a win for everybody. So that was the quarter for Meta. And obviously, we already said it, but these numbers are just ridiculous when you think about the size of the company and the fact that they've been performing well for the past couple of years, right? But I do think it will slow down as we get into 2025 because they're hitting up against their own comps, which makes it tough to continue this 20% revenue growth. And they even said it in their guidance. They expect it to be 8 to 15. But at the end of the day, this is why I wanted Meta to be my third largest holding. I have a lot of conviction in what they're doing, not just with their core business where they're actually seeing AI related gains by being able to charge more for ads, even though impressions are down. That is a really good trend that I want to see continue, but also their future looking stuff like the Ray-Ban smart glasses I've been a fan of for a while. Orion, I think, is super interesting. And that's a space where I feel like if they're not leading yet, it's where they can really add new diverse revenue streams that don't exist today, trying to be that kind of next computing platform. Now, there's no guarantee that that's going to happen, but there's never a guarantee that anything's going to happen. That's the risk that we take whenever we invest. But the CapEx spend doesn't bother me, right? It's one of those things where, yeah, could they have a little bit more free cash flow on a spreadsheet in Q4 2024? Sure, but who cares, right? Like if you're investing in tech, I don't see why that is a real big criteria that you would care about. At the end of the day, are they going to be in the next thing or not? Are they going to be able to keep up with the tech trends and keep their core business earning while hopefully expanding into new areas? So what did you guys think about the earnings reports or the fact that I sold out of my MSCI position? Let me know down in the comments below. Now, if you're confused about DeepSeek and what all that is about and what happened, I break it down in this video right here. Hope you guys have a great day out there. Financial independence is true freedom. So keep building and stacking wins, and I'll see you on the next one. Peace.